Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. US budget bills, the good, the bad and the ugly. Infrastructure, human infrastructure and defense spending bills are set to pass in the coming weeks. How could they affect crypto? Anti-crypto regulators pending approval. Chairman positions at the OCC and CFTC are waiting to be filled, and many of the top candidates are anti-crypto. Here's what to watch out for. China bans crypto again. The People's Bank of China draws another line in the sand as Chinese crypto exchanges blacklist Chinese citizens. Is this ban any different? Evergrande concerns continue. The ailing property developer misses its debt payment deadline as markets border on the brink of collapse. What comes next? Twitter introduces Tips, the new feature that could change the world of finance forever. Everything you need to know. Institutions continue to accumulate. Despite the recent dip, institutional holdings of BTC, ETH, and other large-cap cryptocurrencies continue to rise. Does this mean the bull market isn't over? Bitcoin ETF bet. Bloomberg predicts the SEC will approve a Bitcoin ETF in the next month for one very important reason. Can you guess what it is? And a closer look at just how volatile things could get in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. There are 3 spending packages waiting to be passed in the United States, which could have a profound effect on the crypto market. The first is the infrastructure bill, which is being voted on today. This infrastructure bill contains not one, but 2 anti-crypto provisions. The first requires poorly defined cryptocurrency brokers to collect KYC on their clients and customers for tax purposes. The second provision requires all crypto transactions valued at over $10,000 to be reported to the IRS, something which will also require collecting KYC from the counterparty involved. Though the IRS has stated that it will not go after miners, validators, or developers as part of the first provision, there is a risk that its attitude could change once the bill becomes law. Similarly, the second provision could be deemed inapplicable to certain cryptocurrency transactions because there is no third party involved in smart contract transactions, though this too is unclear. The second spending package waiting to be passed is the so-called Human Infrastructure Bill, which will be passed shortly after the actual infrastructure bill as per the agreement made by opposing politicians. The Human Infrastructure Bill also contains 2 provisions which could affect crypto. The first seeks to undo a loophole that allows traders to offset certain losses, and the second seeks to push for enhanced reporting of capital gains on crypto. The third spending package waiting to be passed is called the National Defense Authorization Act, and it is expected to pass into law in the coming weeks. Now, in contrast to the other 2, this bill contains a pro-crypto provision which requires the SEC and CFTC to clarify regulations around cryptocurrencies within 90 days of the bill becoming law. An interesting clause to include in a defense bill, to say the least. Anyways, the price tag for all 3 bills is a staggering $5.5 trillion. Now, this could have the counterintuitive effect of pumping the crypto market as some of that money magically finds its way into assets. Not only that, but some of the provisions in these various tax bills are not expected to go into effect until 2022 at the earliest, and others may not go into effect until 2023. It's also likely that the crypto market has already priced in the practical effects of these bills, but there's still a possibility that additional anti-crypto provisions could be discovered, given that each of these bills are thousands of pages long. What effect these budget bills could have on the crypto market is also closely tied to the people who chair the relevant regulatory authorities, and in this case, that's the SEC, the CFTC, and the OCC to a lesser degree. The Securities and Exchange Commission, or SEC, sets regulations about securities like stocks, bonds, and some cryptocurrencies. The SEC is currently chaired by Gary Gensler, who seems to be pro-crypto so long as it doesn't affect the bottom line of the big banks. As I mentioned in my recent video about Gary's recent testimony, however, this seems to be changing now that big investors like Fidelity are pushing for pro-crypto regulations. The Commodity Futures Trading Commission, or CFTC, regulates a broad range of assets like derivatives and commodities, some of which are relevant to cryptocurrency, such as Bitcoin and Ethereum futures. Politicians are set to approve a new CFTC chair in the coming weeks, and it looks like all the candidates are in favor of more heavy-handed cryptocurrency regulations. Case in point, the acting chair of the CFTC is one of these candidates, and he is part of the task force which is set to release recommendations for stablecoin regulations as soon as this week. The Office of the Comptroller of the Currency, or OCC, issues licensing and regulation for federally chartered banks in the United States. The OCC is the agency that gave authority to banks to stake and mine cryptocurrency and use stablecoins earlier this year. As such, the OCC will likely be involved in regulating crypto custody solutions. Not surprisingly, the current nominee for the chair of the OCC is staunchly anti-crypto and believes that cryptocurrency, quote, benefits mainly the dysfunctional financial system we already have. If that wasn't crazy enough, she also wants the Federal Reserve to have total control over the banking system in the United States, something which could foreshadow the rollout of a central bank digital currency, or CBDC. This could be a big problem for crypto, because the presence of a CBDC seems to be the prerequisite for an all-out crypto ban, or at least that's what China's recent actions suggest. Last week, Chinese officials announced yet another crypto crackdown. This time, China has banned all cryptocurrency transactions and vowed to hunt down any remaining crypto miners in the country. The reason for the former is likely because China is getting close to a full-scale rollout of its digital yuan and doesn't want any competition from cryptocurrency. The reason for the latter is because China is trying to clean up its carbon emissions, though there are some conflicting signals there, to say the least. What's interesting is that up until this most recent ban, it was still possible to buy and sell cryptocurrencies in China via OTC and offshore exchanges without KYC. The caveat was that Chinese banks wouldn't help you with any crypto-related transactions, which is old news as far as Chinese crypto investors are concerned. To my understanding, it is still legal to hold cryptocurrency in China, though the latest move by regulators means that Chinese crypto holders have no choice but to hodl. Huobi and other exchanges popular with Chinese crypto investors have also moved to close the offshore loophole by restricting access to Chinese users. Now, that said, most Chinese crypto holders, investors, and miners have already migrated, which is why many have rightfully pointed out that this latest ban is nothing more than FUD. The reason why crypto prices dropped so much in response has to do with low liquidity combined with futures liquidations. In other words, the low balance of BTC and ETH on exchanges means it's really easy to push prices up or down. And when you add the BTC and ETH being automatically liquidated when prices fluctuate, it adds to the volatility. Feel free to watch my video on the dangers of leverage, by the way. That's in the top right. It's not just the crypto market that's over-leveraged either. Leverage in the regular stock market continues to rise to all-time highs, despite the fact that many are predicting a financial meltdown because of Evergrande. Now, I detailed the whole backstory to this in a separate video, which you can find in the description, so I'll just give you a quick recap and bring you up to speed on a couple of things that have happened since my video. So, Evergrande is one of the largest property developers in China, and it owes a lot of money to its investors, over $300 billion if we're being exact. Now, this is a problem, because if Evergrande defaults on its debt, i.e. if it misses a debt payment, that means anyone else who is relying on that debt payment to pay off their own debts now can't pay back those debts. This creates a domino effect where every over-leveraged person who had exposure to Evergrande goes down, which is almost everyone when you remember how connected global financial markets are. In addition, around 40% of China's household wealth is tied up in real estate. So, if Evergrande starts selling off some of its properties at a discount to pay off its debts, this could crash the Chinese real estate market. That would then create another domino effect into other real estate markets around the world, all of which are, of course, also over-leveraged and insanely overvalued. The day that everyone was waiting for was last Thursday, when Evergrande was supposed to pay back interest on its dollar-denominated bonds, which it did not do. Luckily for Evergrande, it has a 30-day grace period to pay that interest, and it looks like it's found a few investors crazy enough to buy its junk bonds to make those ends meet. Unluckily for us, this means we might have another 30 days of uncertainty in both the stock market and the crypto market, further adding to the already insane volatility we're seeing now. The silver lining is that this volatility goes both ways. This means bullish announcements can really move the crypto market, and last week we saw one of the most bullish announcements for crypto this year. This was the rollout of Twitter's Tips feature, which will make BTC tipping possible thanks to the Lightning Network. Though Twitter's BTC tipping feature will only support the Strike app, you will also be able to add your Bitcoin address to your profile to receive BTC from other apps. Better yet, Twitter clearly stated that it won't be taking a cut, and the only prerequisite to using this feature is being at least 18 years old. Twitter Tips is already available on iOS and should be available on Android devices in the coming weeks. I'll be doing a demo on the Coin Bureau Clips channel soon, so be sure to be on the lookout for that. Now, besides BTC, Twitter will allow tipping via Square's Cash App, Patreon, Venmo, and many other fiat currency payment gateways. Note that I won't be demoing those because cash is trash. Twitter is also planning to add an NFT verification feature, which will make it possible to know whether that person with a pudgy penguin in their profile pic put down mad cash or just downloaded the JPEG. Now, the importance of Twitter's tipping feature really can't be understated. It could make Twitter the hub for global payments, and the likelihood of this happening will only increase as new features and platforms are added. This then begs the question of how the hell Twitter was able to get the green light from regulators for this, especially since it looks like some of these tipping features do not require KYC to use. Now, while I'm sure everything about Twitter's tips is above board, if this feature does start to get too big, the banks might call up the SEC and ask them to come in and protect investors, if you catch my drift. Alternatively, if Twitter Tips brings home the big bucks for Twitter shareholders, Twitter's crypto expansion will only continue to accelerate. It looks like this is the more likely outcome, as institutions just can't get enough of crypto. As I mentioned earlier, the balance of BTC and ETH on exchanges continues to fall, meaning people are hodling and not selling. As I mentioned in my weekly newsletter, a lot of this BTC and ETH is flowing into whale wallets, many of which are owned by wealthy individuals and institutions. As reported by Cointelegraph, institutional investors have only continued to increase their crypto holdings as markets drop, and what they're buying is interesting to say the least. Bitcoin is the most popular, and Ethereum comes second. No surprises there. However, Solana was the third most popular crypto amongst institutional investors, at least over the last week. Now, this is surprising because Solana went down the week before, and you'd think something like this would spook institutional investors. The thing is that institutional buys don't always reflect in the prices of BTC, ETH, or SOL because of over-the-counter trading, or OTC, which I probably should have explained earlier. So, OTC trades involve buying an asset directly from an exchange at a fixed price, rather than on the exchange itself. This is because buying on the exchange could have what is called price impact. Essentially, the large orders move the price themselves, meaning you'd pay more than the current sticker price. As such, OTC trades have little to no effect on the price of a crypto in the short term, though they do have the secondary effect of reducing the balance of crypto on exchanges, which could lead to lots of volatility down the line. In any case, the fact that institutions continue to buy, even with all the FUD flying around, is a clear sign that this bull market isn't over yet. If I was a betting man, I would say that these institutions are waiting for a big event, and this big event could be a Bitcoin ETF. A Bloomberg strategist believes a Bitcoin ETF could be approved by the SEC as soon as October, and though I'd normally write off such predictions, this fellow's rationale is spot on, in my opinion. As I mentioned in last week's crypto review, ARK Invest is looking to get exposure to crypto-backed Canadian Bitcoin and Ethereum ETFs. Dozens of crypto-inclined US investors with Canadian accounts have already been investing into these ETFs, and the demand for them only continues to grow as the US drags its feet with its own crypto ETFs. While this Bloomberg bloke believes we will see a futures-backed Bitcoin ETF first, it's possible, if not likely, that a physically backed Bitcoin ETF will come soon after. Besides the fact that Fidelity has been pushing the SEC to pass a physically backed Bitcoin ETF, Galaxy Digital recently filed for another physically backed Bitcoin ETF. This is significant because SEC Chair Gary Gensler mentioned that he was only open to approving a futures-backed Bitcoin ETF specifically. Almost half a dozen firms have filed for a futures-backed Bitcoin ETF since that time, so it's a wonder why Galaxy Digital would even bother filing for a physically backed ETF with the SEC. Now, it's possible that it's just another Hail Mary attempt, but it's more likely that Galaxy Digital sees some wiggle room in Gary's rhetoric, especially since big investors are begging the SEC for a physically backed Bitcoin ETF. Now, if one of these ETFs is approved, it could bring about the top of this bull market, the same way the introduction of the CME Bitcoin futures did back in 2017. If a futures-backed Bitcoin ETF is approved, though, we might not see this same effect, and you can find out why by watching my video about that using the link up there in the top right. Coming to the charts now, we can see that Bitcoin continues to bounce between two significant price zones, specifically the 200-day MA and the 128-day MA. As I mentioned in my video about my personal crypto trading strategy, any significant closes below the 128-day MA could mean we're headed for another bear slump like we saw after the crash back in May. Those long wicks at the bottom of those candlesticks suggests this isn't going to happen though, because that's a clear sign of investors buying the dip. Hopefully, we will find our way back above the 200-day MA by the end of the week. If you're planning on trading, bear in mind that the market is insanely volatile, and this will continue to be the case so long as crypto continues to flow out of exchanges and into wallets. Now, this week's winners are Stellar Network, XDC Network, Celo, Tezos, and Harmony. I must admit that I don't know very much about the Stellar Network, but I do know that Stellar's current price pump is unsustainable. In terms of where it came from, the answer seems to be the 2.0 version of Stellar's blockchain bridge, which lets you swap tokens between 10 different blockchains and Ethereum Layer 2s. That is pretty legit. Now, my basic TA tells me that Stellar could pump a bit more this week, though there is a whole lot of resistance at the 20-cent range. If it manages to push through that, 22 cents is what I'm forecasting. XDC is a cryptocurrency that's made the weekly winners list a couple of times before, and some of you may recall that I take serious issue with its lack of exchange support. Even so, XDC seems to have rebranded as part of its recently released roadmap, which could be driving its current rally, and could lead to more gains in the future if the milestones it mentions are met. As for Celo, its pump seems to be coming from the increasing interest around its DeFi ecosystem, which touched $1 billion in total value locked last week. Fun fact, Celo was one of the 2 crypto projects invited to speak at an IMF event about cross-border payments, the other being Stellar. Like Stellar, Celo has been pitching itself as the ideal blockchain to host a CBDC, and its social media activity suggests this push is as strong as ever. Turning to Tezos, XTZ seems to be rising because of the continued hype around Tezos' NFTs, specifically those on its NFT music platform called OneOf. Tezos also recently announced a potential upgrade to its protocol called Hangzhou, which will upgrade its novel proof-of-stake consensus mechanism. XTZ still looks quite strong on the daily, though there has been a lot of profit-taking around the $7 mark. Last but not least, we have Harmony, whose OneCoin is pumping in anticipation of some seriously major milestones, including but not limited to BTC on Harmony and Aave on Harmony. As with XTZ, one has a lot of resistance between 18 and 20 cents, and I'm skeptical about whether it can break that barrier before any of these big upgrades are deployed. If you want to learn more about Harmony, you already know where to do that, folks. Top right. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description, folks. Thank you so much for watching, and I'll see you all in next week's episode.